this is Jessica, and this video is going to be talking about the accounting equation and the roles of debits and credits. So I'm just going to get started right away. Assets are resources owned by a company and which have future economic value that can be measured and can be expressed in dollars. Examples include cash, investments, accounts receivable, inventory, supplies, land, buildings, equipment, and vehicles. A company that provides a service or product on credit has an account receivable from that customer. Assets are part of the accounting equation and the balance sheet. The equation is presented in this format on the slide. A liability is something a person or company owes, usually a sum of money. Recorded on the right side of the balance sheet, liabilities include loans, accounts payable, mortgages, deferred revenues, bonds, warranties, and accrued expenses. A payable is a liability that promises a future outflow of resources. Examples are wages payable to workers, accounts payable to suppliers, notes payable to banks, and taxes payable. Equity is the remaining value of an owner's interest in a company after all liabilities have been deducted. It can also be referred to as net assets or residual equity. At the bottom of the slide, you can see that the equation for equity is assets minus liability, which is the number you would put under equity on a balance sheet. So equity can actually be broken down and expanded into a longer equation, which can be rearranged, of course, but I have it in this order. It's assets equals liabilities plus owner capital minus owner withdrawals plus revenues minus expenses. Two common types of equity include stockholders and owner's equity. Stockholders' equity, also known as shareholders' equity, is the amount of assets given to shareholders after deducting liabilities. Owner's equity refers to the amount of ownership you have in your business. You can calculate owner's equity by subtracting your liabilities from your assets. Owner's equity shows how much available capital your small business has. Capital is the owner's investment of assets and cash into a business. Capital is a subcategory of owner's equity. It takes into account a broader value of assets in a company and can represent the accumulated wealth in a business or the owner's investment in a business. It includes fixed assets such as buildings and vehicles, cash, business checking accounts, and increase in value due to net profits and decreases in value from net losses. A sole proprietor has 100% ownership in the business. The owner's capital account is shown in the business balance sheet as the owner's name and then the comma capital account. A withdrawal account can be used in business to keep track of the business owner's spending. Therefore, withdrawals in business are transactions in which an owner removes his money from his withdrawal account. Withdrawal accounts are usually set up for partnerships so that each owner can have his spending accounted for. This spending is usually of a personal nature, so the withdrawal account serves the primary purpose of keeping personal spending separate from business spending. In a partnership, each partner is generally allocated and a certain amount of pay, which he can use for his own spending needs. Whenever a partner needs money, he can simply use a withdrawal from his account to pay for it. The withdrawal is not an expense for the business, but instead a reduction of equity. Revenue is the income generated from normal business operations and includes discounts and deductions for returned merchandise. It is the top line or gross income figure from which costs are subtracted to determine net income. It increases equity from sales of products and services to customers. Examples are sales of products, consulting services provided, facilities rented to others, and commissions from services. Revenue normally appears at the top of the income statement. However, it also has an impact on the balance sheet. An expense is the money spent or costs incurred by a business in their effort to generate revenues. Essentially, accounts expenses represent the cost of doing business. They are the sum of all the activities that result in a profit. They decrease equity from costs of providing products and services to customers. Examples are costs of employee time, use of supplies, advertising, utilities, and insurance fees. So my last slide is debits and credits, and I'm just going to kind of read these off. Assets. Increase to an asset account is a debit. Decrease to an asset account is a credit. Liability. Increase to a liability account is a credit. Decrease to a liability account is a debit. Equity. Increase in an equity account is a credit. Decrease in an equity account is a debit. Capital. Increase in an owner capital account is a credit. Decrease in an owner capital account is a debit. Withdrawals. Increase in an owner withdrawal account is a debit. Decrease in an owner withdrawal account is a credit. Revenue. Increase in a revenue account is a credit. Decrease in a revenue account is a debit. Expense. Increase in an expense account is a debit. Decrease in an expense account is a credit. All right, thank you so much for watching. That was everything I had to cover.